With DSCR loans, or is there like a loan term like there are with other, mortgages? Is it 30-year?
Yeah, there's definitely loan products out there. Like there's the traditional 30-year fixed. There's hybrids like a 40-year fixed, or even a 10-year interest only or a 5-year interest only. So depending on your cash flow and what you're needing, if you want to pay it down fast, you'd probably go for a shorter term. And there are adjustables out there too, like a 3, 5, and 7. But where the rates are right now, it doesn't make sense because it's probably an eighth or a quarter point better than the 30-year. Doesn't make sense to get into something that could adjust higher. Not only that, I mean, the other thing to think about when you're getting into DSCR loans compared to traditional loans is they have stuff called prepays on them, prepay penalties. They come with a standard 3 or 5 year prepay penalty. And what that means is if it has a 3-year prepay, if you refinance, if you sell it in any way, if you pay that loan off in full, they're going to charge you a penalty. And it's usually somewhere, like if it's a 3-year, it's like a 3-2-1, like 3% 1 year, 2% the other year, 1%. Traditional loans don't have those, so you could come and go as you please and things. So in a DSCR, when you're looking at it, you really have to think of it your long term. I'm keeping this for 10 years. It doesn't matter. Or I may want to get out of it. I just put a flip into a DSCR loan because I had to keep it. Now I couldn't sell it, but I want to sell it in 2 years. You got to watch your prepays on these because they could add, if it's a 5-year prepay and you sell in 2 years, and if it's what they call a straight 5, meaning you could pay 5% of your loan balance. If you had a $200,000 loan, you could pay 5% of that or $10,000 just to get out of the loan.
Wow, I didn't know they did that. I guess it's because they're hoping that you take the whole time because of all the interest they're going to get. So they say if you pay it off early, you're going to have to pay this penalty. So we get our money either way. Is that the?
Well, yeah, they're like, we're going to put this money aside for 30 years. If you're going to pay it off early, we're going to have to find somewhere else to put it as a lender. So we're going to charge you, is give us time to make sure that we can still make the kind of return we're looking for too. So that's probably the one thing you are going to have to look at when you're looking at DSCR. Also, just understand rates. From a conforming to a DSCR, you're somewhere on best case a 0.5 point higher to probably traditionally, somewhere between 3/4 and 1 point higher than a traditional Fannie or Freddie loan. So they're going to have prepayment penalties and they're going to be a little bit higher on your rates. So that's why you want to look through all your numbers, verify everything before you get in contract with something or are looking or going to refinance it to make sure you are going to break even or make money.
So they're a little bit higher, and is that because they are easier to get into in some ways than the other, than the traditional loans?
Yep.
So they're kind of compensating for that with the higher rate.
Yeah, typically when you look at underwriting, like if you have a higher credit score, you're going to get a cheaper rate. If you have better income, you're going to get a cheaper LTV. They look at all these factors, and we've just taken out the income from you. So it took a little bit from the people who are lending it. It's a little riskier because all they're saying is this property right now is going to make money. Mm-hmm. We don't know if someone doesn't pay rent for 6 months, who's going to pay that bill? They don't get into those kind of nuances in your income. Mm-hmm. So it's a little bit higher just because they don't check and verify those kind of things. It's a little riskier loan for them, so they're going to charge you a little bit more.
So it seems like that. I see now why this is the loan that you're continually talking about, because that's what would halt somebody who's trying to get into real estate investing. Because if they don't have an income over the past 2 years that would normally meet the requirements for a traditional loan, right? This allows them to still be able to get a loan. And so there's a bit more of there's a bit higher interest rate, but they can get into it and they can make their investment and they can hopefully, make a profit on the rental and on the value increase of the home.
Correct. Yeah. Okay. And I would say in our markets, in looking at people, I'd say half the people at least are people who just write off as much as they can on their taxes. They take advantage of being in business and writing everything off they can, which does not help them qualify for loans. So half it might be people just getting in, but the other half are people who write down everything they can legally just to make sure they don't pay the IRS more than they have to. Doesn't help them when they go get a loan now. This kind of loan will help those clients who write everything off get a good loan as long as you have good credit. Mm-hmm.
Yeah, awesome. Okay, so the clients that are writing everything off, and that's most of your clients,
Yeah.
you're saying, yeah, that's going to help them. The
Yeah.
DSCR is going to help them.
Yeah, it's a perfect setup for them.
Yeah, that makes sense. So you kind of, it seems like dials, right? You're like, okay,
Yeah.
so how much is this going to help me? How much is this going to help me? And writing off my taxes is what I want to do, and therefore the DSCR, that slightly higher interest rate, makes sense to me.
You nailed it, because I don't want to pay the IRS more, so I may have to pay on my loan a little bit more, but that's a choice I'm making. I want to show as little income over here as possible, but then I qualify, and then I'm getting a DSCR instead of a Fannie or Freddie, and it might cost me a little bit more here, but once again, it's a business expense. Interest is a business expense, so it is a decision people make. More people make that decision than the other decision of paying more taxes.
Yeah.
And qualifying for different loans.
Well, and there's the added benefit that you don't have to have been in business for 2 years as well.
That's huge.
Right?
Yep. That's